I want to talk, though, more about the state of the economy, GDP, and what this means as we go forward for a lot of investors. And we're going to do that with Wells Fargo Senior Economist Tim Quinlan, who joins us in the stream right now. Thank you for being here, Tim.
My pleasure.
So let me ask you this. As you point out, most economies globally will register sharp rates of contraction in 2020. But then when you start looking at different regions across the globe, there's not only the expectation for growth, but I think in your most recent note, you pointed out here in the United States, by the third quarter of 2021, we are back to recovery. I mean, we will have finished our recovery. We won't be where we were in 2019, but the slowdown's in the rearview mirror.
Yeah, I mean, I think the way you think of it is, we're going through this god-awful period this winter, but then on the other side of it, what you've already had is a pretty swift rebound in goods spending, and then that's augmented by a broader recovery on the services side of spending. And so, you get faster rates of growth in the second half of last year. And in fact, we do have the headline level of GDP growth getting back to its pre-pandemic levels by the third quarter of next year.
And when you look at other regions, because some investors will be making their decisions with this kind of data in mind, China's GDP, I believe you're predicting, will grow about 9.6% next year. What is it about China, other than they are the largest market essentially in the world, that makes that's an optimistic number, is it not?
It is, and it's a little bit of kind of a coiled spring effect. I mean, China used to put up double-digit percentage growth rates on a pretty regular basis from the late 90s through until the early 2010s or so, and then a kind of deliberate transition away from government-sponsored expansion of corporate debt there kind of resulted in them slowing to an engineered slowdown in the kind of mid-single-digit growth rates. And as they now kind of ramp back up coming out of this slowdown period, it's sort of lower base effects there that afford them that year of faster growth. I wouldn't drop my coffee if you actually had 10% GDP growth, but then it probably starts to taper back off into the mid to high single digit growth rates after that.
Now let's look what's happening in the Eurozone. I mean, when you hear the Prime Minister of Greece being optimistic about the multi-trillion euro bailout that's going to be coming, and bailout's not the right word, but the stimulus package, their growth is expected to be 3.4% in 2021. Does that signal that the Eurozone's out of the woods, do you think?
Well, if you were the Greek finance minister, you'd be enthusiastic too. I mean, you remember in the last cycle when, they had these long-term refinancing operations where it was, loans to the financial sector of these troubled Southern European economies with the expectation that it would all get paid back. And, there was no way that you'd get outright fiscal policy expansion and what would have been deemed as a bailout of these profligate Southern European economies back then. So the fact that you are seeing not just a low interest rate environment and expansionary policy on a monetary policy side, but an outright spend and fiscal policy support as well is certainly pretty supportive for growth there.
So when we wrap all of this up for an investor, you called COVID-19 a magnitude 9 quake. I'm now watching new shutdowns about to take place where I am in New York City. We're seeing that in California and major population centers of this country. It seems as if, the recovery that we're counting on for third quarter might get delayed because that would mean more people out of work, wouldn't it?
I think if I could leave you with a lasting impression here, it's the next 3 to 4 months are going to be worse than financial markets are braced for at the moment. But then beyond that, especially if you get to a point where you've got adequate distribution of this vaccine, across not just the advanced economies, but the emerging market economies as well, then you'll see something that we've never had before, which is, in an ordinary period, you have pent-up demand manifest itself through goods spending. In most advanced economies, goods spending is small relative to the much larger services side of the economy. You've had suppressed services spending in this cycle. We've never seen that before. So that as that kind of comes back online, we're looking for that to drive growth in a more impactful way. So whereas in the near term, I don't think people are pessimistic enough, in the second half of next year, I don't think they're optimistic enough yet at this point.
All right, so let's wrap this up with one last question. We don't expect the Federal Reserve to increase interest rates at all. I've had guests come on here starting to talk about inflation. As an economist, Are you worried about inflation? Because when I used to cover the Fed, for 10 years, they've never gotten inflation, right? It hasn't existed. What do you think?
Well, I think that when you look at the expansion of not just the monetary base, but also M2. So it wasn't uncommon before to have a big expansion of the high powered money. In this case, you had a big expansion of regular cash money as well. And there's maybe scope for a bit of inflation, which is why the Fed has tried to steer expectations toward this new inflation level targeting. But as General Putnam said to the troops before the first battle at Lexington and Concord, don't fire till you see the whites of their eyes. I think I'll wait until I see the whites of inflation's eyes north of 2% before I start really dialing it into our forecast.